Welcome to Quick Invest Brief. The idea of early retirement, escaping the daily grind, is a dream for many. And a common question that comes up is, can I actually retire on $500,000? It sounds like a significant sum, but is it truly enough to fund your financial freedom for the rest of your life? Today, we're diving deep into that question. We'll look at the famous 4% rule and break down the critical factors that determine if 500K could be your golden ticket to retirement. Get ready for powerful insights, briefly told. Let's find out. First, let's talk about the most common guideline for retirement withdrawals, the 4% rule. This rule suggests that you can safely withdraw 4% of your investment portfolio each year, adjusting for inflation, and your money should last for at least 30 years. It's based on historical market data and aims to provide a sustainable income without running out of funds. So if you have £500,000 or dollars, a 4% withdrawal means you could theoretically take out £20,000 or dollars per year. That's about £1,667 or dollars per month. Now the big question is, can you live comfortably on that amount for decades? The answer, as you might suspect, is it depends. Here are the key considerations that determine if £500,000 or dollars is enough for your early retirement. Your cost of living. This is the single biggest factor. Living in a high-cost city like London or New York is vastly different from a rural area in the UK or a smaller state in the US. Your current expenses and what you project them to be in retirement are crucial. Do you plan to downsize, move somewhere cheaper, travel extensively? Healthcare costs. This is a monumental difference between the UK and the US, especially for early retirees. In the UK, the National Health Service, or NHS, largely covers healthcare costs, significantly reducing this burden. You might still have prescription costs or consider private health insurance for faster access, but the core care is covered. In the US, if you retire before you're eligible for Medicare at age 65, you'll need to fund private health insurance, which can be incredibly expensive and unpredictable. This alone can make a huge dent in your $20,000 annual budget. Inflation, the silent wealth killer. Your £20,000 or dollars today won't buy the same amount of goods and services in 10, 20, or 30 years. The 4% rule attempts to account for this by adjusting your withdrawal for inflation annually, but prolonged periods of high inflation can still put a strain on your funds. Your lifestyle expectations. Are you aiming for a minimalist lifestyle, or do you dream of frequent international travel, expensive hobbies, or fine dining? A frugal retirement might be sustainable on $20,000 a year, but a luxurious one certainly won't be. Taxes. Withdrawals from investment accounts, particularly in the US, may be subject to income tax. Even in the UK, while ISAs are tax-free, other pension withdrawals are typically taxed. Factor in how much of your $20,000 will actually be net income. Debt. Carrying mortgage debt, car loans, or credit card debt into retirement is a massive drain on your limited income. Ideally, you want to be completely debt-free when you stop working. What about focusing solely on high-yield investments to generate more than that £20,000 or dollars per year? It's an attractive thought, but comes with important considerations. Types of high-yield products. You might be thinking of things like high dividend stocks or ETFs. These are companies that pay a significant portion of their profits back to shareholders regularly. High yield bonds or bond funds. These are often from companies with lower credit ratings, offering higher interest payments to compensate for increased risk. Money market funds. While generally lower risk, their yields fluctuate with interest rates, and they are primarily for preserving capital rather than aggressive income growth. REITs, real estate investment trusts. These can offer high dividends from real estate income. The appeal: if you could generate, say, a 5% or 6% yield on your $500,000, that would be $25,000 to £30,000 or dollars a year, significantly boosting your income. The risks of sole reliance. However, solely relying on high-yield products for all your retirement income carries substantial risks. Dividend cuts, bond defaults. Companies can cut or suspend dividends during tough times, and bonds can default, directly impacting your income stream. The highest yields often come from companies or bonds in distress. Capital erosion. Often, high-yield products achieve their yield by sacrificing capital growth. You might receive higher income, but your initial 500,000 could shrink over time, especially after inflation, leaving you with less and less to generate income from. Interest rate sensitivity. High-yield bonds and some dividend stocks can be very sensitive to changes in interest rates, affecting their value. Concentration risk. To achieve very high yields, you might end up concentrating your portfolio in a few specific sectors, increasing your overall risk if those sectors decline. A balanced approach, blending growth and income. Instead of an all-or-nothing approach, a more robust strategy for early retirement often involves a diversified portfolio that balances both growth and income. You could allocate a portion to solid growth stocks or growth-focused ETFs to ensure your capital continues to appreciate and outpace inflation over the long term. This provides the growth needed to potentially allow for higher withdrawals later or recover from market downturns. The other portion could be in carefully selected income-generating assets, like reliable dividend-paying companies or balanced income funds, to provide consistent cash flow. This blend aims to give you both ongoing income and long-term capital appreciation, allowing your portfolio to sustain itself for potentially many decades. The exact split depends entirely on your risk tolerance, time horizon, and income needs. For many, £20,000 or dollars a year might feel tight, but there are still broader strategies to make that 500K stretch further or to bridge the gap. Build a cash buffer 1-2 years expenses. This is a critical strategy, especially for early retirement. Keep 1 to 2 years worth of your projected living expenses in easily accessible cash or very low-risk cash alternatives like money market funds. This acts as a buffer against market volatility. If the stock market experiences a downturn, you can draw from this cash buffer instead of being forced to sell your investments at a loss. This gives your investment portfolio time to recover, significantly reducing what's known as sequence of returns risk, the danger of poor market performance early in your retirement derailing your plans. This cash reserve provides both financial security and peace of mind. Extreme frugality, geographic arbitrage, drastically cutting expenses, or moving to a much lower cost of living country or region can significantly extend the life of your funds. Part-time work, semi-retirement. Many early retirees don't stop working entirely. A part-time job, consulting, or a passion project can provide supplementary income, reduce the strain on your portfolio, and offer mental stimulation. This is sometimes called barista fire. Developing passive income streams. Before retiring, focus on building additional income sources that don't require active work, such as rental property income or royalties from creative work. Delaying retirement, even slightly, every extra year you work allows your portfolio to grow further and reduces the number of years you need your money to last. Even a few years can make a substantial difference. Considering state pension, Social Security. Remember that your state pension in the UK or Social Security in the US will eventually kick in, often at age 67 or later. This can significantly boost your income, so your 500K might serve as a bridge until those benefits begin. So, is it possible to retire on £500,000 or dollars? The honest truth is, yes, it can be possible for some, but it's highly challenging and requires extremely careful planning, discipline, and often significant lifestyle adjustments. It's rarely a comfortable, lavish retirement, especially if you plan to retire very early. Your personal expenses, health costs, country of residence, and how long you need the money to last are the real determinants. Instead of focusing solely on the 500K number, focus on your annual expenses and build a plan to cover those, whether through a lump sum or a combination of income sources, including a carefully balanced investment portfolio and a crucial cash buffer. What's your financial independence number, or what challenges do you foresee with early retirement? Share your thoughts in the comments below. If you found this brief helpful, please hit that like button and share it with someone dreaming of early retirement. And for more powerful insights, briefly told, subscribe to Quick Invest Brief now.